Okay, I believe we are live. This is the Chit Chat Money Investing Power Hour number 94, if I'm not mistaken. So getting up close to 100 here. We've got some things on the docket for today's show. We always, for anyone who is new to the show, these are general, broad discussions about anything financial markets. We can talk about our own personal investing, news, whatever we want to discuss. Little bit of housekeeping items before we get started, though. If you like our work and you want a free newsletter in your inbox, feel free to check us out. Chit Chat Money Substack, totally free. And it provides a supplement to any of our other show research as well. And then like and review or share with a friend. It always helps. So tell a friend, be like, those guys at Chit Chat Money, they're doing a great job. And we would greatly appreciate it. But before we get into things, I do want to talk about our sponsor for this episode, public.com. Public just launched its new high yield cash account, offering an industry leading 5.1% APY, no fees, no subscription, and no minimums or maximums. That means you can grow your cash with 5.1% interest with no strings attached. It's as simple as that. Again, that's 5.1% interest with no fees, 5.1% interest with no subscription, 5.1% interest with no minimums or maximums, 5.1% interest with up to $5 million of FDIC insurance. That's just 5.1% interest, straight up, no strings attached. Sign up today at public.com/chitchatmoney. This is a paid endorsement for public.com, 5.1% APY as of December 20th, 2023, and is subject to change. Full disclosures and terms and conditions can be found in the podcast descriptions. High yielded cash accounts are available for U.S. members only. With that said, let's kick things off. Brett, any news topics for this week?
We're starting earnings season, so I thought Delta Airlines would be a fun one to discuss. I believe they're the largest, if not, they're pretty close to the largest airline in the United States, perhaps one, and definitely one of the largest in the world as well. Got some funny topics. I have an interesting, perhaps the most painful investing question you could put on someone as a little tease, and I know you got news around Musk's new pay package or potential one, and then other airline related stuff, the breaking of the Spirit and JetBlue deal, according to a court ruling, which I saw some headlines on. But my favorite part is that our friend Davey Day Trader Global is back. I don't know if you saw that right before we recorded, and he is going long Spirit Airlines. And funny enough, this is a really rich guy, so I don't think he's going to be too upset. But immediately after he put out his video that Spirit he was going long Spirit Air, there was a Wall Street Journal report that they are in talks about restructuring and concerns over paying off the debt and managing that after the deal didn't close. So the stock went down approximately 10%.
Yeah, brutal. I
Merger arb's
like
tough. It's tough. It's tough to invest in shitcos.
there were
Sorry for that.
a lot of really smart people that I respect, investors that I follow and generate a lot of ideas from were long Spirit, and this broke the wrong way. Just goes to show, I think, how unpredictable some of these things are and how courts can really rule anyway.
Hey,
And
if you're merger arb and you win 8 out of 10, then you're probably still doing pretty well. Maybe even less, depending on what ones you get into. Hey, sometimes you lose. Got some
yeah,
questions though. Sorry, you're gonna get into it. We have one. Any thoughts on Spirit and JetBlue? This is from Tyler, who is always basically the sole source of our questions. We really appreciate it, Tyler. Says any thoughts on Spirits and JetBlue? Ryan will have those later. Thoughts on shorting Hawaiian, giving the JetBlue break, and then some other ones. Thoughts on buying Spirit debt, given that airplanes are worth more in the market than they are on their balance sheets, and more of a macro one we might hit later. So, do you want to hit? Seems like people are interested in this deal break. Why don't you go through your notes on that first, and then we'll have a discussion.
yeah, I guess I'm not an expert on the case, but and usually not an expert on anything merger arb related. However, basically, there was something called a hot doc in this case, where essentially Spirit's executives, or maybe it was JetBlue's, one of the executives basically talked about raising prices after um after the merger closed, and that ended up, I think, probably being a concern. And ultimately, the judge ruled that they thought this was anti-competitive and that it would eliminate one of the only low-cost operators for customers. I don't know if I agree. There's been so much airline consolidation over the last 30 years that it seems weird to step in now to the one low-cost operator who obviously can't operate after this. They can't operate low costs anymore. So uh it feels like it is kind of ironic that I think Spirit will have to increase prices probably in order to try to stay afloat here. And that was the concern about the merger going through, is that prices could increase. So it there was it was kind of interesting to see everyone's reactions. A lot of the people, I think the typical response was that the judge got this wrong, which if you're an investor, it doesn't matter. Like you you knew the risks that was there. That's why the spread was so large. And so it's I think it's on you. And I don't think it's a very good look to just blame the judge because you didn't have to buy the stock. Um, but I, with that said, I don't know if this is the right choice. It seems like I'm a little bit opposed to any deal being considered anti-competitive if the company can't operate on its own after the fact.
Yeah, I saw you had a tweet about that with iRobot as well, where yes, there can be some synergy considerations or local monopolies or whatever. With iRobot, I don't get it when people are concerned about Amazon mapping your home. What are they going to do with that information?
Someone
iRobot's already doing that on its own. Like, okay, they're doing
someone
that.
mentioned
So
that to
it,
me, and
yeah.
I was like, okay, let's say they map their home. What are they going to do next? What are they
Well,
going to do with that? Offer you a low cost, advertise you a low cost rug that's the exact parameters you're looking for and ship it to you for free?
yeah. Also, iRobot's already doing that. So if there's concerns about that, okay, like that company is already doing it, and they're going to be doing it on their own. And yeah, I get what you mean. Where JetBlue may end up being a beneficiary here because one, they don't have to swallow this company anymore, and it's a different operating environment. And two, if Spirit goes out of business, yes, they're going to have to compete with some of these bidders, but with the airline manufacturers, remember we talked last week, Boeing, or excuse me, airplane manufacturers, behind and having huge backlogs. Specifically, Boeing is struggling so much. These companies like Spirit, if they go bankrupt or decide to file for bankruptcy, well, hey, there's going to be, a potential to buy these airplanes for, kind of in an auction deal, but they'll probably be competing with other companies in that one as well. Yeah, we saw the question there. Look, I don't know much about this deal. Um, but
I would go read Andrew Walker's right up on it.
yeah.
He's
Yeah.
covered it well. And it's
Well, here's the question I was going to ask is thoughts on buying. I don't know anything about Spirit's debt, but it makes sense that maybe buying the debt could be interesting if there's going to be a lot of strategic value out there for these other airlines.
yeah, potentially that would be something I've never done before. So I'd have to look into it more, obviously, but it does make sense. I mean, airplanes are tough to come by right now, uh, given the supply constraints with Boeing. So it seems like those would be worth a lot to a lot of other airlines. Maybe there's some salvage value there, um, but it's a very different type of investment than what I typically go for. So I'd be concerned. The other thing I find interesting, Hawaiian Airlines didn't trade down that much on this, and it really seems like it should have, assuming that this is the new precedent for airline consolidation. There's obviously some nuances, some differences, less flight overlap, but at the same time, they talk about less overlapping routes. That's what Alaska mentions, but there's less routes to begin with. So, assuming that, I guess the only other difference is that Hawaiian's not really a low cost operator.
Yeah, that could be the difference where I don't know. But you can't expect the judge to act rationally because the concern is okay, well, Spirit, yes, is the low cost operator, and they're getting absorbed by a company that's a different one and could reduce that, but they're now not able to be the low cost operator because they're going to go bankrupt. So I think the way to preserve that would have been to let them get bought out by someone, and then I don't know how you maybe can't restrict that, but I don't think there should be unless it's someone that absolutely dominates an airport or route paths or whatever, and maybe you can even do some concessions. I do not think the airline industry is, I mean, what these things are hyper competitive. These things are, as we'll maybe talk about, commodities for the core part you're buying, but have on these add-ons, like the credit cards and stuff like that. I don't
Every
I
time I
don't
book
know
a
what the
flight,
concerns. Yeah.
every single time I book a flight, I just look up the lowest cost flight on Google.
Yeah, well, it's because
No, I am.
you're not on the travel credit card team. So,
I'm on the Alaska card team.
well,
I still just
you
look
gotta
up
do
if there's one
well,
flight that's like the good thing is that Alaska in most cases is the cheapest provider from where we're going. From
yeah.
Seattle, it's often the cheapest provider, but I price compare anyways.
Yeah, but you got to think of these point, right? Well, we don't need to go 10 minutes on maximizing your points generation, but if you book on Alaska, you get 3 times points. So, whatever. Um, yeah,
So then
I don't know. I don't have any
let's
thoughts
say
here.
that
Hawaiian,
okay,
I don't
all
like Hawaiian. I
these
mean, I don't like Hawaiian either. Maybe it's a good short. Alaska is a well-run airline, even with this thing that happened with the door blowout. I mean, it's one of the only ones that's actually grown significantly and generated good returns on invested capital over the last 25 years. But it's an airline, so I don't know.
but you're
I still,
contradicting yourself here because on the one hand, it's these are super competitive. It's an airline industry that's hyper competitive, and someone could come in and do the same thing. But now you've got lock in with all these credit points. And it's like
yeah.
these customers are locked in. Let's say they're locked in.
I mean, it's
Is
a good
it still
business.
as
Yeah.
competitive? I don't think it's as competitive as it used to be.
Uh, yeah, that's fair. That's fair. But
So maybe it is the right time for someone to step in now. It doesn't need to be, I'd be more concerned if it was one of the big four that was buying this, but it does feel weird to block the fifth and sixth or seventh and eighth largest players from combining.
yeah, I agree with that. Yeah, I mean, from an investing perspective, I don't like the Hawaiian anything to do with the Hawaiian deal. I think one of the reasons I like merger or excuse me, one of the criteria I need for merger arb is that I would want to own the business at somewhat close to the price I'm paying. And I think I'm not losing money, or I think it's kind of a fair value. For example, Activision Blizzard, it's had lost its way. The culture was tough for the last 5 to 7 years, but it seemed fairly cheap if that deal didn't go through. And I think with these airline companies, with iRobot, yes, the spread is so wide, but man, you might the downside, as we saw with Spirit, is incredible. And if the Hawaiian one doesn't go through, what's interesting is it's the same thing where okay, well, they might have to do a restructuring, and okay, who's going to have these assets? Like the downside there is incredible. I mean, the stock, what was it, a 200% premium to where they were trading? I
Which
think it
one?
was almost Hawaiian. Hawaiian.
Oh, the buyout.
Yeah,
More. More. Pretty sure.
270 or
They
something
were
like
trading at
that.
like $5, and I think the buyout was for like 16.
So like 270 maybe. Yeah.
And it is, yeah. Merger arb. I thought I liked it because all the cases were going as I expected. But the one time you lose money, I'm like, maybe I don't like merger arb so much. And I wasn't in on this, but I was definitely thinking about taking a flyer on Spirit, and it's all the investors I listened to, it seemed reasonable that the deal would go through. So yeah, I think if I am doing merger arb, I would rather own something where bankruptcy risk isn't that high if the deal doesn't go through. And obviously the spread's not going to be quite as wide, but to me, it's a little more sense of security there. We do have some other questions, though. I don't want to talk merger arb all day. I want to take this one from Tyler. He says, do you guys think you found another Sprouts in your portfolio? That one has had every part of your thesis play out perfectly. Thank you. Yes, pat on the back for us. No, I think it's a good question. I was revisiting Sprouts today, and I want to talk about the Sprouts investment because we might have some listeners who don't know what Sprouts Farmers Market is, don't know what our thesis was, don't know when we bought it, that kind of stuff. So I'm just going to rehash it. In 2020, I believe you first wrote it up.
Found,
And
yeah, I don't know if I wrote up, found it during the spring 2020. Yeah.
right. And at the time, they had been going through I would call it a rough patch prior. They had a management team that grew quickly, kind of grew so fast that they turned it into a bit of a shitco, more or less. It was not earning a whole lot of money. It was highly levered. A lot of the quality at some of the stores was poor in terms of
Yeah,
like the
well,
produce quality.
uh I think two things are wrong there. One, they weren't highly levered. They're like one times or one times EBITDA. Second, it wasn't the quality, it was the promotions. So they had good produce as they're trying to improve it even further, but the problem was they were doing insane coupons and discounts that were driving down margins.
They went from $150 million in debt to $550 million in debt, and earnings didn't change. I think that would qualify as
Wow. I mean,
levering
and
up.
they're earning, but their EBITDA is like 400 something million. So I mean, it's not a concern.
Yeah, maybe bankruptcy wasn't a concern, but the quality of the business certainly changed, you could say, from the time
Honestly,
when it was
I
under
think it was
private equity.
honestly, I think it was smart. I mean, it's super low cost debt. And I was really un
This was
unhappy that
prior
they
to
paid it back.
2019.
Yeah, I was unhappy when they paid it down. Honestly, they should have used. There's no need. It's super low cost, and they were could their cost of debt, if I don't remember, it was sub 5% fixed, and their free cash flow yield is over 10%. So just buy back, and you're generating enough money to pay up down the principal every year.
Yeah, but they were maybe I think it was smart. I think Sinclair probably realized that there were a lot of underperforming stores and that maybe the EBITDA wasn't, he knew that they were going to take away the coupon clippers and struggle with EBITDA at some of the stores. I think paying down the debt was probably the right move in a super competitive industry where
Yeah,
it's
but
not
they didn't.
certainty. This isn't software. Like,
Hindsight, though, hindsight, they didn't
and
need to pay
EBITDA,
it
it's
down.
not EBITDA. EBITDA is not earnings.
Yeah, but I mean, they're paying down like, we can look at our friends over at FinChat if I can bring it up. I, I know this, but I've followed them since 2019 briefly. Trust me, they did not need to pay down this debt. Share count could be lower, stock price, like they could have created shareholder value. Hindsight's obviously perfect, but like they didn't need to pay down the debt. They would have had no liquidity concerns.
All right, go through the thesis. What was your thesis?
Well, one, the stock was insanely cheap. So the free cash flow yield was above 10%. And probably in spring 2020, everything was really cheap, but it's probably 13-14% free cash flow yield. And the new management team had come in And they had decided in 2019 when they arrived that they wanted to get rid of this coupon clipping strategy. And that strategy had led to deteriorating operating margins for multiple years, even though revenue and comp sales were going up. So they got rid of that. But during spring of 2020, grocery stores did extremely well just because everyone was going for that type of stuff, less restaurants, more to that. Comp sales were doing fantastic. But once we lapped that, they had lapped the pandemic catalyst, the one-time bump, and they got rid of these coupon clippers, which really, really hurt comp sales. So comp sales looked ugly for a few years. And when you have negative comp sales with retail, I mean, we were even debating it internally, if you remember, Ryan. We were like, man, like these comp sales keep going negative. It's not good. But margins were getting better. Earnings were actually growing. And what they were saying was
Gross
consistent. I
margins.
mean,
Gross margins. Operating margins
uh,
declined, lapping 2020.
sure from 2020, but I'm saying from 2019. Um, like they basically went down slightly from 2020. I mean, for all intents, I mean, it was like
It's
barely below 2020, but from compared to 2019 and 2018, significantly higher. And people thought that wasn't sustainable. I've seen the bear cases on that, but we were talking internally. The comp sales were ugly, but we trusted management on the strategy of they got rid of the coupon clippers. Those were low margin customers. And then once we lapped that, we were growing comp sales again. And I think part of the thesis was, well, it's so undervalued and they have decent returns on invested capital. It's probably like 12, 15%. And there was just a ginormous runway to grow store count across the United States. We thought, they had about 300 stores at the time, and we think they can get to 1,000. That pretty much sums it up. And the management team, Sinclair, who came over from Walmart, is really sharp, so we liked him. I think that's about it, right?
an honest, seemed
Yeah.
honest, candid.
Yeah. Yeah.
Maybe it's just he's Scottish, but he seemed very candid. And when problems were facing the business, he was pretty straightforward about it. It was a very clean thesis that I haven't really come across since
Well, I remember at the
because
time,
it
Ryan,
was,
or go, sorry, go. Go, sorry.
yeah, it was the, it's a store, it's a unique concept. Health enthusiasts is who they were targeting. It took a while for them to really kind of get that messaging across, I think, because they had to go through getting rid of the coupon clippers, but 70% of the items sold in store are attribute based items, kind of diet specific, vegan, paleo, that kind of thing. So in my opinion, if margins are sustainable, if that's who you continue to target and you continue to attract them, they had a clean balance sheet. They were buying back. It was cheap, and they weren't able to grow store count that quickly because of all the supply chain issues around the time. But now they're in a position where they can certainly grow. They added distribution centers, so it seemed like the supply chain was improving for Sprouts. They made it one of their big targets to keep every store within a 250-mile radius. Prior, they had grown store count a little quickly, and some of them were kind of out of reach of distribution centers, or not within that 250-mile distance. So it seemed very clean. Maybe wasn't the best like performing business on the comp sales line, but profitable, better than a lot of its peers on the margin side, and it was buying back a ton of stock and it was cheap.
But here, do you everything seems perfect now, right? Because stocks more than doubled. But Ryan, do you remember how concerned you were with these quarterly reports in 2021?
The comp sales.
Yes, you were. Do you remember this?
Well, I think everyone was. That's why the stock sold off.
But what, like, how do you like? I think listeners would be helpful in understanding of having those concerns, but then weighing it versus like, okay, well, when does it turn into a sell decision?
Well, it was a little easier for us because the multiple doubled essentially. It went from $20 to $30. We made a 10% position in the portfolio, and it went from $20 to $30 without earnings significantly improving because the comp sales were coming down. It was lapping COVID. So for us, it was kind of easier. We sold it around 32, I think. came back down to 20 and we ended up buying again. So at the time, I mean, I don't know. It's hard to read between the lines, especially with a grocer that has negative comp sales. The good thing was we were seeing similar trends out of some other grocers. So I got the sense that, okay, they're not alone. And margins weren't deteriorating that much. And every time I listen to the conference call, I get a little bit of a sense of surety that, okay, it's not the end of the world.
Earnings were
Because,
stable, earnings per share were going up.
yeah, we did sell it though at
Yeah, I know.
around $30 and ended up buying it back.
Yes, we did do that, and then we sold. Yep, yeah, that's true. That's true. We ended up
Which
buying back around.
kind
Well,
of,
no, we ended up selling around 30, low 30s, bought it back, I think around 30 in 2023 or late 2022. Can't remember, but it was a very volatile stock, which was also not fun. But I guess it's maybe it can be fun if you time it correctly, but it's not fun if you're just holding that one. And it was a frustrating one to hold for many years because we go down a lot in earnings reports because everyone hated the comp sales, but earnings look fine. They're buying back stock. There's no risk of bankruptcy, and you had to have some extreme patience. And now, I really don't know why it's going up so much, but
yeah, that's the other
I
thing I was
wouldn't
going
be
to
selling it.
say is I'm starting to realize how hard it is to, I think, hold your winners, where this was a winner, but a lot of it came from multiple expansion, which
But that's
maybe
all. That's all
maybe
big
it
winners.
deserves. NVR from 1997 to 2003 was a six bagger and the multiple didn't change.
That's an exception. I know we had that on the show that we just covered. That's an exception to the rule. Most hunter baggers, remember the
There's
Chris
multiple
Meyer
expansion.
book,
Yeah.
multiple expansion is huge.
Yeah. The and maybe it deserves a more expensive multiple, but it makes it harder to own because you don't feel the margin of safety as much. They're not able to buy back as much stock. But I think the lesson for me is that if you find a unique business where it seems like it has a replicable model, don't haggle over pennies and just hold it and don't try to get in and out because it's way too hard to time.
Oh yeah. Yeah.
I
I
say
mean,
just keep owning it. It's a little easier to do in personal accounts, but when things are going right for you, don't I'd say don't mess with it.
unless the valuation becomes extreme, which would be typically unless it's just an absolute absurd getting better, like the business is growing like gangbusters, it'd probably mean it's like triples or quadruples within a short time span, at least from my perspective, because if you bought it, it probably wasn't. I mean, if you're underwriting 100% IRR, find me those stocks. But I think the key is if the business is good and the quality is improving, you will almost always be benefited by listening to David Gardner in this case. Now, I know there's people out there that aren't the biggest fans of the Motley Fool, but David Gardner, I think, undisputably is one of the best investors of this generation. And the key reason is because he never uh, trims the flowers. And I think, again, what
And
I mean by
and he
flower,
adds to his winners.
yeah, that's even harder. I think that's the next step. Maybe that's the next step we got to take is to be able to do that. But the reason you sell is when I think, yes, if the valuation gets absolutely extreme, like some things got in 2021, sure. But only sell if you're very concerned about the business quality or changing the business. Who cares if you wouldn't buy Sprouts at 50? If you were holding from 20, you're going to be happy over the long term, I think.
Yeah, you're
All
frozen
right.
for
Looks
me.
like Ryan froze. Hopefully. Uh-oh. Uh-oh.
I
There
think it
you go.
might be on your end.
Yep, I saw it. I saw it. Yeah, you froze on my end. Okay. Looks like we're back. All right. Next topic. Let's see if we got any other questions. Have you guys seen the pitches around multifamily housing REITs at unusually high cap rates? Any thoughts on those? Nope, do not. Like any I don't care. Sorry. Don't pay attention to those at all. Ryan, I'm assuming you haven't either. No.
I have not. No.
The thing about
No,
real
man,
estate is I get so bored that I can't do it. These type of things. I just fall asleep. It's like healthcare companies.
I've grown more like I think something that I have a problem with is I see so many people make money in real estate that it feels like unoriginal or that it's too easy, that everyone's doing it, that it doesn't make sense. And it's there are probably a lot of ways to make money in real estate. The only thing I don't really like is unless you're like just buying like literal REITs, like securities, it's pretty hands-on. If it's an
Oh,
investment
yeah.
property, like you can hire someone to manage it or whatever, but when you're getting started, I think for the most part, you're gonna have to work on that property a lot. So it's just not my cup of tea, not my style of investment that I prefer.
Same
But
here. But Discover Financial is, we got a question here. Did you read Discover's earnings? I have not. It's on the top of my list to read next. But why don't we go to another topic? Because we're about halfway through here, Ryan.
yeah, let me go
I
through.
like yours. Yeah, go to yours.
So, well, we can talk about the Elon pay package in a little bit, but I was reading a shareholder, or not a shareholder, a hedge fund letter this week from Bonsai Partners. It's run by Andrew Rosenblum. He is on Twitter, so great follow. Highly recommend it. Uh, he mentions in the letter that he really likes the IT services industry and he lays out a pretty good case for it. So here's a quote from the letter. He says, "The image below presents a selection of leading IT engineering companies and their aggregate performance from 2010 to 2022. Note that these businesses profitably grew revenues 20x to 40x over the past 12 years." I know a lot of people just listen to the show, so I'm describing an image that you can't see, but basically it goes through four businesses: Lobent, EPAM, Endava, and Nagaro. And like he said, all of them either grew revenues somewhere between 20x and 40x over 12 years. And they all trade somewhat expensive. So EPAM last 12-month price to earnings ratio is 28.4, Endava is 27.9, Nagaro, which has a little more hair on it, is 14.3 times, but it's also grown 36.5% over the last 12 years. And then Globant is way more expensive at 57.4 times. But all these businesses have grown rapidly. And for us who are kind of consulting haters and maybe less so in the IT space, I've always wondered, and I've never really worked with, never really had like an IT services provider come and help me in a business. So I've never had that experience. So he actually asked the question. He says, "Why outsource to an IT services company in the first place?" Which I think is a question we've asked here multiple times. And he lays out some good reasoning around why these businesses are so important. He says, "As you likely know, there is a persistent shortage of software engineering talent in North America and Western Europe, leading to the high cost of these employees." For people that don't think this is true, go to a big bank's careers site, careers website, and look how many, just look up the term developer or engineer. Look how many job openings there are. It is really hard for a lot of these Fortune 500 businesses like a Hershey or kind of a generic company that doesn't specialize in technology to attract these developers. He says most software engineers prefer to work directly inside technology companies instead of more traditional Fortune 500 type businesses. Since the need for engineering ebbs and flows around technology projects, staffing needs are volatile, which means an employee hired for a specific project might be repurposed on a new task or be let go after the project is finished. It's far more interesting, prestigious, and job secure for an engineer to gain exposure to multiple companies by working at an IT services firm. It makes a lot of sense. Like if you are a developer going to a company that doesn't specialize in anything tech related, where developers aren't kind of a core core employee component of the business, it's you're probably hired for certain projects where all of a sudden you're questioning whether you're valued at the company after the project is done. It's so much easier to just work at an IT services or an IT kind of consulting business and have that consistent job security and be moved from project to project. So it makes a lot of sense. And I know specifically for EPAM and Nagaro, they have cost advantages because they hire talent from Eastern Europe and India. So curious your thoughts here. Are these companies that would interest you?
I think potentially I get, and people might be like, well, who cares if it's boring as long as it makes money? I honestly think it's not being bored with an investment is important because then you actually pay attention to what matters. I find these businesses boring, but clearly they're good ones. I think yeah, it's fairly durable. It's much more, I'd say, durable and useful than executive suite consulting, business consulting, the McKinsey style stuff, compensation consultants. Get on my high horse there. It's much, much different because they might describe them as consultants, but really this is contract work. And as someone who worked briefly in the mechanical engineering space, I mean, it's very, very common to the giant mechanical contracting firms, which are generally private. They do stuff that's similar where you have a smaller company, they go to you for a project, they contract you on that, and you do it for them. I think these do make sense, for sure.
Yeah, and I remember looking at EPAM a year ago because a, a big chunk of their employee base is in Ukraine or was in Ukraine. And so the stock like just dropped some absurd amount after the news was announced between Russia and Ukraine. Sorry, I'm stuttering. But I looked at it and I thought, what the hell is so special about this business? Like, why has it performed so well? And it seems like, well, first of all, this describes it well. There's constant need for these types of services and a growing need, especially since they specialize in a certain vertical, which is pretty much engineering type projects. The If you're an
Software engineering,
Accenture,
right?
software
So
engineering
yeah,
type
yeah,
projects, if you're Accenture or one of these big consulting firms, there's so many verticals that I don't think the revenue upside is quite as clear as just being like a tech specific consulting firm. So I like it. I think EPM is pretty interesting. They have a good CEO. I remember looking at difficulties with their staff right now, given that they've had to relocate a lot of them. But I thought it was a really good shareholder letter. If you want to check it out, just look at Bonsai Partners. They write a good letter, or follow Andrew Rosenblum on
yeah.
Twitter.
You have the link, or you want to toss it
No,
in
I
the
didn't
chat,
include it
maybe?
here,
Okay,
but
it's
yeah,
fine.
I can throw it in the chat.
All
I
right.
wanted to start doing these discussion questions because someone DM'd me before the show and he said, you should, have you listened to the Barstool podcast? I was like, yes. And we've tried to incorporate this stuff before, but I want to start doing this more. Zeros and heroes from the week. And I know you didn't see this before, I don't think. Or you did. No, no, you didn't. Anyway, the zeros and heroes from the week. Who in financial markets had a great week and who had a rough week? I think that'd be a fun way to
Oh,
start these shows from now on.
all right.
Do
Little
you have
structure.
any in mind? Who are the heroes and zeros from the week?
Oh, well, I mean, we talked uh Spirit. I think that's clearly the the one there. There's a lot of people owning that one. Read a couple pitches on
Zeros.
that. That's the
Spirit
zeros.
shareholders
That's
are
the
the zeros
zeros.
for the week.
Yeah. Heroes, I guess people that are gonna accumulate some fees on these Bitcoin ETFs. I'm stealing your notes here, but yeah, that one makes sense.
Elon.
Elon, yeah, well, he needs to get more, 100 billion more dollars of Tesla shares if he's going to be properly incentivized
Isn't
to
it
own this thing. Yeah, I mean, he's a gaslighter. It's okay.
the Matt Levine wrote about it, which I'm happy he did. And he's like, this, he more or less called it extortion because it's like, he's saying, well, that money you used to give me is gone now. I own Twitter with that money. So for me to be properly incentivized, for me to spend time on this project, you have to make it worth my while, which is a good
Uh,
threat. That is a good threat if you're a Tesla board because well, you're going to lose your stock premium if he's not. as involved, if he stops showing up on the conference calls and if he doesn't talk about it as much.
Yeah. All right. I got another zero, and the stock is off 78% from all-time highs. I hope you haven't seen this meme. You may have because it kind of went viral and I did retweet it, but I know you're not on Twitter all the time, so then we don't see everything. But I'm going to share this one. I didn't include it because, well, I just wanted to see your reaction live, so I'm going to share my screen here. I think some of the people watching on the video will be able to see it too. Did you see this one?
No. I've seen the meme format like that, but not that one specifically.
I was
Describe it for
laughing.
people that are listening.
Yeah, so it's the one I think it makes sense where it's a pregnant woman drinking and smoking, and it's like, no, it doesn't affect my baby. And then there's 12 years later, and this kid is looking at a computer screen, and he says, Alibaba is at 23% free cash flow yield. At some point, it has to be a buy. I don't know why, but this one it made me laugh so hard. I mean, I was laughing for a solid minute. It was a good one. Whoever did it, W2I Realist. So thank you for that one. But I think that's a zero for the week because I mean, the stock's down 80%. It keeps falling. And look, you could have argued it's cheap at 10% free cash flow yield. You could have argued it was a cheap at a 15% free cash flow yield. And now, hey, at some point it has to be a buy. And that leads to relates to my other topic, which is a poll I did that would probably I honestly don't know how I'd answer this one because it seems so hard. If you have $50,000 and you're forced to put it into one of two places, so again, no other options. You can either put it into Alibaba or Bitcoin. Where are you putting it?
Oh gosh. Maybe
It's
Bitcoin.
some
Maybe
guy.
Bitcoin.
I did the C results. I did C results for the third one. Some people can, to see if they don't want to answer. And some guy said I'm putting mine in C results.
Yeah. Yeah, that's
Honestly, I
good
think I
idea.
would choose Bitcoin. I think I might choose Bitcoin. 44% of people chose. We almost had 1,000 people answer this. 44% chose Bitcoin. 38% chose Alibaba. So
Which do
that's
you
some
think has the
sentiment on.
most margin of safety?
Oh God, Bob, probably. I don't know.
Think
I don't know.
because
No,
I
probably
think
Bitcoin.
Bitcoin is it's so universally like talked about. It seems like you're gonna have buyers for a long time, no matter what. I could be wrong, but I would have thought people would get bored of it after 2 years of not really doing much. But people still swear by it. People love it. I don't think the utility has changed a whole lot, but I could see this being in like the same place in 20 years and people are talking about like
Uh,
the next leg up. Whereas Alibaba, it does seem like it could get nationalized or something tomorrow.
yeah, the CCP could say, "Bye bye, your your money's gone. See ya."
Yeah.
And they can do that in any country, but I think the stock price is telling you that the risk in China, if you're reading the news, is much higher. Got a comment here. I know what Franklin Templeton is clicking on that poll. Okay. Before we get to another serious topic, um, I want one more funny joke. This is kind of an inside one. Where did you see that the Secretary of State for the United States got stranded in Davos? We didn't get our invites. Sorry. I was kind of shocked for the World Economic Forum this week, which is a wild event. Yeah, I recommend watching the strange stuff that goes on there. But apparently, it was stranded after his Boeing plane broke down in Switzerland. And good anonymous account, I think it's anonymous, Doug Ott said this would not have happened to Jeff Immelt. Do you get that? Do you get that reference?
Who is Immel again? That was
The
GE or
General Electric CEO that had the second private jet tailing him just in case the one that he was using broke
oh my
down.
God.
That was another funny one. People are funny online this week.
I started
But
reading a book this week called it's the one from Jeff Graham called Dear Chairman, where kind of talks about the evolution of like shareholder activism and how it's become more commonplace. And it's a really good book.
Interesting. What's it called
And
again?
Dear Chairman
Okay.
by Jeff Graham. It's Graham, Gramm. I think Warren Buffett's talked about it a couple times, or he's recommended it before. And some of the executive egregiousness or expenses are so crazy going through that.
I
They,
love it. I love it. I love hate it. I hate love it. I don't know how to say it.
I should have brought up this one for today's show and found the excerpt, but this one's not that crazy in terms of like executive egregiousness. But in 1928, I believe it might have been 1929, Ben Graham. First of all, it's such a different period in time in terms of financial reporting because companies did not financially report. So Ben Graham, who I've always kind of thought of as just like a great investment teacher, but he was really like a lot more. He was literally like a pioneer in terms of value investing, like literally looking at it was unthought of to go look at a company's financials.
Yeah, if you read
People,
the who is it, the Jesse Livermore stuff, it's people just reading the tape and trying to be some mystic watching these stock prices. No one did
yeah,
any of this fundamental analysis.
it was a lot more about who else is buying. Like, is there somebody that's going to be buying up shares? You should get in front of it. A lot of rumors going on. And Ben Graham was one of the first ones to be like, no, the stocks are worth something actually. And so he found that there was, I can't remember what it was called, but there was some organization, some national organization that the all companies had to report to. They had to give their financial reports there and they had to like physically deliver them. And the only way to go see those financial reports was to drive down or train down to Washington, D.C. and get your hands on the copy. So he did that and he found, what is it? I can't remember the railway. It was some railway and it was a part of, I'm going to blank on this, but it was some railway and they had the stock price was $64 a share. They were doing about $6 in earnings, which that was what they would show investors is they're like, we did $6 in earnings this year. So whatever, a little over 10 times earnings. They had $90 in cash, in net
Wow.
cash, just sitting
Dang.
on it. And like they
Just
would call them
cash.
investments. There was some investments, mostly US
Okay, yeah.
treasuries.
Yeah.
And he's like, so he started an activist campaign. He's like, first of all, he wrote a letter. I was like, can you guys distribute this? And the shareholder or the executives were like, you have no idea the complications of running a railroad. We need the money. He's like, it doesn't affect your business. You have $90 in cash a share. These US treasuries, I'm just asking for some of the excess capital back. You don't need this. You guys are profitable. And he finally got all the other shareholders. He would go one by one and get the shareholders and he'd be like, look, they could special dividend us out more than we paid for the shares tomorrow. And he got them, got two board seats, and they gave him a special dividend of like more than the entire share price. So it goes to show that if you were able and willing to go be an activist back in the day, there was plenty of alpha to be had. But with that said, it's a lot harder than just publishing a letter on the internet. You had to literally go place by place and find the shareholders and convince them, which would have been quite tough. But that was kind of the first one Jeff Graham talks about as the evolution of an activist investor.
All right. Sounds like a book recommendation for everyone. I'd also recommend The Fund that we did talk about in another podcast related to activism and related to Boeing, who we've kind of been on ever since that debacle in this supply chain and these quality control issues. Someone said that they basically need an activist in there and to get rid of the cultural stuff that came on with that. Who is that company that they merged with that kind of They moved the company that spurred the move to Chicago and the shareholder stuff. I forget the name of the company, but it was the late 90s merger that kind of ruined everything. Or a lot of people
Blanking on
argue.
it.
Yeah, but who they said they need an activist in there to
Frederick
get.
Douglass, something Douglas.
Yeah, Douglas. Yeah. Gosh, why can't I remember? But someone was saying they need an activist and that they would be a national hero, at least for the United States, obviously. Could anyone reasonably do this? I don't know if there's anyone with the size.
McDonnell Douglas.
McDonald, right,
No,
right. Yeah.
no, I don't think so. And I'm not sure you want. Listen, I don't think it's Dave Calhoun, right? No, is that's different. That's the basketball coach. I always
No,
get the
it's Dave.
Syracuse
I think
coach
it's
and
that's Jim
uh
Boeheim. That's Dave
no, isn't
Calhoun.
there like a
Calhoun.
Calhoun? Isn't there a Calhoun somewhere?
Yeah, but
Whatever.
I think it's Dave Calhoun.
I don't think he's the
Yep.
right guy, but I worry about Boeing having some very profit motivated shareholder like making important decisions for like the safety of, flyers. So it feels like there would be some corner cutting, I imagine. I don't know an activist investor. I don't
Here's
think that's the best scenario.
Bezos. Then they merge with Blue Origin. He takes it over.
I
Let
don't
him do
think
it.
Bezos has any interest.
I know. He doesn't, but I think he could do it. Okay, serious topic. Delta earnings. Did you look at these at all? I know it's a pretty important company. On they got if you're talking about
I did
kind of
not.
the economy and stuff, but I'll sum it up. Let's see, just get some numbers here for context for the listeners. 2023 operating income 5.5 billion, $2 billion in free cash flow. So capital intensive business and they're investing a lot. 2024 guide for 3 billion to 4 billion in free cash flow. Full year can never say this word. Remu remuneration. I don't know why I can't say this word. Money they got from American
Immune.
Express. Remuneration from American Express in their credit card partnership of $6.8 billion. That was up 22% year over year. I say that because that's kind of the higher margin loyalty program stuff that maybe is a bit more durable than the cyclical airline prices that, gets less affected by oil prices and stuff like that. Now, you got that number. Okay. Market cap's 24 billion. Stock went down after this report. They got about $20 billion in debt and they have a decent amount of assets and have an EV of around $37 billion. Or wait. Yeah. If we add it all together, yeah, the math is correct. So, EV to free cash flow of between 9 and 12, depending on whether you use the $3 billion in free cash flow or the 4. Does the stock interest you at all at these prices? Because I think the only thing that attracts me to a company like this is the durability. I think they're a very durable asset. The brand will be around in 20 years, I think. That's what I'm saying.
I think you could be confident saying that now. Obviously, airlines are kind of notorious for being like commonly bankrupt. They go bankrupt all the time, reemerge out of bankruptcy, that kind of thing. But I think it's a very different business today than it was 15 years ago. My diff It's so lumpy. The earnings are so lumpy for these major airlines. It's like Michael O'Leary, the CEO of Ryanair, said they are always 3 or 4 years away from their next crisis. And there's just no predictability in terms of free cash flow, in my opinion. So maybe that's an opportunity for a lot of people. But we're talking about 20 times trailing free
Uh,
from 15
Trailing, yeah,
times
sure.
legit free cash flow. I'm not sure I'd want to pay that for like an airline.
Yeah.
How much of it's being returned?
Dividend yield. I don't think they're doing any buybacks right now because they're using it to pay down the debt. They have some expensive debt, so it's honestly good. They're going to reduce their interest expense. Dividend yield's only 1%. I mean, the earnings ratio is like 5, but I would look at cash flow when looking at an airline.
You have
I don't think they'll have much
oil
trouble covering
prices.
the. Yeah, like okay, I was going to mention while I was thinking while you were talking, you mentioned the volatility. They could easily generate zero in free cash flow in 2024, just if a few variables change just a little bit. So yeah, but when we covered Ryanair when we were doing, back when we were doing the not so deep dives, which little teaser, this week we had another one of the special episodes covering an investor, but next week and next 3 weeks we will be covering specific stocks. One from me, one from Ryan, and then one in an interview we're recording next week. So don't you worry, we're still doing stock research episodes that'll be like an hour long and comprehensive. But after we covered Ryanair, I like the business a lot, at least from compared to other airlines. You seem to like it a lot. Is that still the airline that most attracts you as a potential investment?
Yeah, definitely. It seems the most well positioned to grow, just given the cost advantage. Some of those quotes that I hear about $20 flights, that's insane.
Yeah, but the thing is, anything extra, like remember half of the revenue come from the upcharges. So if you want any bag, pay a little bit extra, all that stuff, which it still makes sense. And it makes sense for specific people that are trying to be the cheap traveler. And yeah, and it works because, as we talked about on that episode, it's much easier to run Ryanair in Europe than Frontier or Spirit in the United States because the geography is just not nearly as dense. I mean, you get the Midwest and the Rocky Mountains and all that good stuff.
It's a different
So
business. It's a
yeah,
very
it's just
different
the distance. It's
thesis.
just it's just the distance. Yeah.
Yeah, it's a very different thesis than if I were betting on Delta. So I think, yeah, it's much easier. That's probably the one I'd be most excited by. I mean, I do
I'm
own an airline.
That's true. We do
It's
own our own.
just
Well, it's
for
trading at
all
zero.
a whole bunch
It's
of different reasons.
That one is trading at a $0 enterprise value. Related to that airline, though, they said that their labor shortages are dissipating, pilot shortages are going down, and I think that's good for, I don't know, the costs coming in there because the bonuses they've had to pay to these pilots, which is fair to the pilots, but from an investment perspective, has been quite the headwind. Also interesting. Now, I don't know how much Delta knows about this and whether how precise this guidance is, but they predict or are guiding American Express revenue, which I'm assuming is correlated to spending volume, to grow on their Delta cards by 10% next year. So I think that's a good see-through to Amex.
Okay, 1 minute left, 2 minutes left, roughly.
Yeah. Do we want to? You did the ad at the start. Do we want to maybe not cheat? Maybe we do
Sure.
an extra. Yeah. Just so as we're doing those. Yeah. Give them a full ad.
Discussion questions to wrap things up. Have you made any changes to your portfolio this week? If so, what are they? Follow up. Anything on your watch list right now that you could see yourself buying soon?
Okay. First, no. Last thing I bought was coupon uh in what would it be? It was either the first week of January or the last week of December. But the thing that is interesting to me is Ally Financial. They the stock's below 32 again, so it's getting a little bit cheaper after they went through the stock just kind of zoomed higher after the interest rate pause stuff and the sentiment around that since it's kind of a hot potato around the Fed decisions. And I'm concerned about the executive suite because of the change in management. That's really my only concern here. I'm not honestly concerned about the balance sheet, but maybe that'll age really poorly. But yeah, I could see myself buying that one once I get some cash coming in here. And that is and Coupang as well. I'd say those are the two at the moment. So I could see myself. I don't own Ally right now, mainly because it had shot up to 35, and I don't know. But I think right now is a decent price. We're below book value. Should be able to generate pretty solid returns on equity going forward, I think.
Yeah, I FOMO bought Ally at 35,
Oh,
roughly.
right. We've had a tough start to 2024.
It's okay. And these are small buys, and it's going to be like, they're things that I imagine I will add to over time. This week, portfolio changes. I did buy a little coupon. It's down a lot. Uh, so added to that position. It was down 8% after a downgrade and then 4% the next day. So well below my original cost basis. And I bought a little bit more. On my watch list, I gotta say, Booking Holdings, it's up there. It's shot up my watch list quite quickly. Biggest travel company in the world. And I'll be talking about it next week on an episode. So, well, that episode won't come out for a while, but I think it'll come out in 2 weeks.
Maybe three.
Very,
TBD on our
very interesting
schedule. Yeah.
business.
Okay.
So that's up there for me.
All right. I'm excited to listen to your report. Yeah, that's one I had never really looked at, but it is much cheaper than Airbnb. Let's see. Okay. I'm gonna read off some look at stuff on my watch list. Spotify is above 200 again. It's a tough one. Uh,
Boy,
yeah.
that is so disappointing.
Okay,
That
we
is
got
so
here.
disappointing.
Okay, we got the tobacco companies. British American Tobacco is at 29. Philip Morris International is at 92.5. Altria is at 40. I believe British American Tobacco and Altria are both basically at a 10% dividend yield. And if I look at Philip Morris here, we are at 5.6. Do those interest you at these prices?
Yeah, Philip Morris does. I like, I don't know. With British American and Altria, we've gone over this like a million times, but just some of the positioning in what we call kind of the modern nicotine world. I don't think they're that well positioned. You still might be able to make a good amount of money just purely based on that dividend, but I certainly wouldn't be reinvesting it. I would, if anything, I'm taking that and putting it somewhere else. Philip Morris, 5%, almost 6% dividend yield is nothing to shrug at, and volumes are growing in that business, and they're potentially higher margin than their core cigarette business. And cigarettes themselves are not declining that much because they're in better geographies. So I think there's a lot more to like there. You're just paying a little more.
All right. I think that's a great way to wrap things up. Thank you for everyone that joined us live. For anyone listening on the podcast, these go live every Thursday, 12:30 p.m. Eastern, 9:30 a.m. Pacific, and do the math for the rest of the world. If you enjoyed listening to this episode, give us a review on Spotify or Apple Podcast. And if you think that someone else that you know would enjoy listening to this show, click that share button, send it over to them. We'd greatly appreciate it. Let's hit the disclosure. We are not financial advisors. Anything we say on this show is not formal advice or recommendation. Ryan, I, and any podcast guest may hold securities discussed in this podcast. We may have held them in the past, and we may buy, sell, or hold any of these securities in the future. Thank you, everyone. We'll see you next time.